Hey everyone, and welcome to today's Explainer. We are going to dive straight into the proven tools and mindsets that legendary super investors actually use to build lasting wealth. And don't worry, we're totally skipping the hype and the confusing Wall Street jargon. If you've ever felt like the stock market is just, a giant casino, well, get ready to completely shift your perspective.
So here is our roadmap for today. We're going to cover 5 key areas: figuring out if you're actually an investor, the incredible power of starting early, the 7 golden rules, how to navigate market madness, and finally, valuing a business. Let's get right to it.
Section 1. Are you an investor?
All right, before we even think about looking at numbers or stock charts, let's challenge how you think about the future with a quick pop quiz. Imagine I give you 2 choices. Choice A, I will give you $100 in cash right now today. Or choice B, I will give you a brand new Mercedes next year. Which one are you going to take? I'm guessing you didn't have to think very hard about that one, right? You'd wait a year for the car. But what if I offered you $100 today or $100 next year? Well, you'd take the cash today. I mean, why wait if there's absolutely no reward for it?
This little thought experiment brilliantly illustrates the dividing line between a spender and an investor. A spender expects zero return for waiting, but an investor, they inherently believe that tomorrow offers more. Being an investor really just boils down to your willingness to sacrifice a little bit today purely because you have faith in a much wealthier tomorrow. It's all about finding that sweet spot where giving up a little cash today yields a massive reward down the road.
Section 2. The power of starting early. Now, if you've got that investor mindset, you need a tool to actually build that wealthier tomorrow. And that tool is compound interest. To really grasp it, let's look at a super relatable scenario. Meet our 20-year-old fireman. He makes a pretty meager salary, but he makes a firm commitment. He's going to save just $1,000 per year until he retires in 50 years. Now, $1,000 a year is a pretty small amount. Does it really matter where he puts it? Well, look at the dramatic difference in outcomes for that exact same savings effort over 50 years. If he keeps it in cash under the mattress at a 0% return, he ends up with 50 grand. Safe? Sure, but totally stagnant. Now, if he puts it into bonds or real estate, growing at around 3% a year, he gets $116,000. But check out that third scenario. If he puts it in the stock market, which historically averages about a 9.8% return, that $1,000 a year absolutely explodes into over $1.35 million. Same exact effort, vastly different fortunes. That right there is the magnifying effect of compound interest.
But listen, where you put your money is only half the equation. The other half is time. Just look at the final net worth based entirely on what age you start saving that same $1,000 a year in the market. If our fireman waited until he was 40 to start, he'd end up with about $190,000. But if you start at age 15, you're looking at $2.2 million. Just a 5-year delay, waiting from age 15 to age 20, costs almost $1 million in final wealth. Time is literally the most powerful asset you have.
Section 3. The 7 golden rules.
Okay, so we know we need to invest, and we definitely know we need to do it early. But throwing money at random stocks, that isn't investing, it's gambling. We need to lean on the wisdom of mentors like Warren Buffett and Benjamin Graham. They proved decades ago that consistently beating the market isn't just a coin flip. They follow proven guardrails. You have to think long-term, focus on quality and safety, do your actual homework, absolutely refuse to follow the herd, diversify wisely, and above all, keep learning. Let's zoom in on a couple of these crucial rules.
Rule 5 warns us not to follow the herd. It is completely human nature to want to buy when everyone else is euphoric and cheering, and to sell when everyone is panicking. But honestly, following the crowd right into a bubble or following them off a cliff in a panic is a guaranteed recipe for disaster. It's like wandering straight into the smoke just because everyone else is doing it. The absolute best investors fight this urge. They stay calm, they stay rational, and they think completely independently while everyone else is losing their minds.
And then we have Rule 6. You obviously need diversification so one bad stock doesn't completely sink you. We've all heard it, don't put all your eggs in one basket. But there's a flip side to that, having way too many baskets. Research actually shows that the sweet spot is somewhere around 20 stocks. If you diversify way beyond that, you're honestly just diluting your absolute best ideas with a bunch of mediocre ones. You want to make your best ideas count.
Section 4. Navigating market madness.
Now, as you go out and try to apply these rules, you're going to come face to face with the main antagonist of your investing journey, the erratic stock market itself. Benjamin Graham, the father of value investing, created this fantastic allegory to explain it. He said, imagine you own a business with a partner named Mr. Market. Now, Mr. Market is a nice enough guy, but he suffers from some really wild, unpredictable mood swings. One day, he's totally euphoric and offers to buy your share for way more than it's worth. The very next day, he's deeply depressed, convinced the world is ending, and offers to sell you his share for absolute pennies. Here's the catch. The actual underlying business hasn't changed one bit. Only Mr. Market's emotions have. Those daily stock prices you see, that's just Mr. Market shouting out random numbers based on whatever mood he's in today.
So the absolutely crucial takeaway here is this. Mr. Market's bad days are actually your greatest opportunity. As Warren Buffett famously put it, be fearful when others are greedy and be greedy when others are fearful. When Mr. Market is super depressed and shouting out irrationally low prices, well, that is exactly when the smart investor steps in to buy great companies on sale.
And that leads us directly to the ultimate safety net, the margin of safety. This simply means buying a business at a price that is significantly less than its true value. Think of it as the equivalent of buying a $10 bill for $5. When you build in a margin of safety, your calculations about the future can be completely wrong and you still won't lose much money. It is literally your financial armor against Mr. Market's wildest days.
Section 5. Valuing a business.
But wait, to find that margin of safety, you actually need to know how to calculate what that $10 bill is worth in the first place, right? This is the ultimate tool to defeat Mr. Market. Let's see how this plays out using a real-world example. Apple. At the end of the day, a company's worth is simply the present value of all the future cash it's going to generate. Look at the first scenario here. If Apple sees a 5% annual growth in device sales for the next 40 years, the company's worth about $675 billion. But what if growth goes flat? The value drops almost in half, down to $391 billion. And if they face intense competitive pressure and profit margins shrink, boom, the value plummets to $220 billion. The fundamental value of any company rests entirely on two things: how much its profits will grow and how long that growth is actually sustainable.
Because trying to predict 40 years of future cash is honestly really tough, investors use shorthand metrics to make life easier. The absolute go-to valuation metric is the price to earnings, or PE ratio. It's super simple. It's just the stock price divided by the company's earnings per share over the last 12 months. What this number tells you in plain English is how many years you would have to wait at current profit levels just to get your money back. So, if a stock trades at a PE of 20, you are essentially paying for 20 years of current earnings up front. And this gives us a really handy, practical cheat sheet. Over the past decade or so, an average company trades around a 15 PE. If a company is cyclical or has pretty low growth, honestly, it shouldn't cost you more than a 5 to 10 PE. But if it's a truly exceptional company with a strong competitive advantage and high growth, you might gladly pay a 20 or even 25 PE for it. You generally get what you pay for. The goal is to hunt down those truly great companies when Mr. Market is having a miserable day and puts them on sale for a 15 or even a 10 PE. Which brings us to our final thought for today. Charlie Munger, who was Warren Buffett's longtime partner, once said, "The game of life is the game of everlasting learning. At least it is if you want to win." Investing early in the stock market has the proven power to completely transform your financial life. But the market? It's always evolving. So the final, and maybe the most crucial rule of all, is that you must never stop learning. We've given you the roadmap today, the mindset, the math, the rules, and the tools. The only question now is, will you take the next step, do your own homework, and truly master your financial future? Keep learning, stay focused, and I'll catch you in the next explainer.